Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include trade deadline day, my interview with Foundation Mortgage's Marc Halpern on builder confidence and the stratification of buyer demand across metros, giving credence to the phrase real estate is local, and it's Payrolls Friday. Today's podcast is brought to you by Encino, makers of the Encino Mortgage Suite for the modern mortgage lender. Encino Mortgage Suite's three core products, Encino Mortgage, Encino Incentive Compensation, and Encino Mortgage Analytics, unite the people, systems, and stages of the mortgage process into a seamless end-to-end solution embedded with data-driven insights and intelligent automation. See how Encino can support a homeownership journey that your borrowers and your team will love at encino.com. Remember when today was supposed to be the trade deal deadline day? Though, admittedly, it doesn't seem as fun as Major League Baseball's trade deadline that happened yesterday evening. Hours before President Trump's sweeping tariffs were set to take effect, he announced new, steep rates for more than 6 countries. And he delayed the deadline again, with most of the tariffs now set to take effect next week. His trade agenda has yielded both victories and setbacks as he reimposes suspended tariffs and finalizes key deals. Wins include securing agreements with the European Union and South Korea that raise tariffs to historic levels and boost U.S. exports of fossil fuels and aircraft. These moves, however, have also disrupted global trade alliances, hurt industries like auto and agriculture, and sparked inflationary pressures, with many deals still unfinished and uncertainty clouding the long-term economic impact. It has weakened the dollar and unexpectedly boosted investor interest in emerging markets, attracting billions in capital flows. While Trump's aggressive tariff threats, such as a new 25% duty on Indian exports, have sparked concerns about the dollar's reserve status and rising Treasury yields, recent bilateral deals and signals from the Treasury about steady auction sizes and possible buybacks have calmed market fears. Despite ongoing trade tensions, investors are shifting focus back to macro fundamentals, though questions remain about U.S. consumer resilience and the long-term economic impact of these trade policies. The July Federal Open Market Committee meeting on Wednesday, which was marked by Chair Powell's notably hawkish tone, cast a long shadow over the Treasury's announcement of increased buybacks of long-dated bonds yesterday, signaling a tightening policy environment. The odds of a September rate cut have dropped from around 95% a month ago to less than 40% currently, as Powell emphasized that the economy isn't showing signs of being constrained by restrictive policy. The Fed appears to believe that the neutral rate of growth may be higher than previously assumed, making the case for easing less urgent unless economic data significantly deteriorates. With two key jobs and inflation reports due before the September FOMC decision, the Fed's posture suggests cuts will only come in response to clear signs of slowing growth, especially if unemployment pushes toward 5%. Until then, the most likely scenario is a delay to later in the fall, with any dovish shift being carefully messaged via updated projections and guidance later in the year. For today's interview, I wanted to welcome to the show Foundation Mortgage's Marc Halpern to talk about builder confidence and the stratification of buyer demand across metros, giving credence to the phrase real estate is local. He's CEO at Foundation Mortgage, beginning his career in the mortgage industry back in the 90s as an LO, and he emphasizes the customer for life principle, creating a solid reputation based on word-of-mouth referrals.
The overarching topic is building. Builders, builder confidence, what's going on. And before we get into some of the metro-specific stuff like South Florida, I specifically want to talk about, but can you kind of give an overview of the general landscape when it comes to builder confidence? Because I feel like there's conflicting narratives of, oh, well, the people want builders to build more, and so there's demand there for sure, and the government has taken up housing as a bipartisan issue, but builders aren't building anywhere near the rate that they should be to satiate demand, and materials are high. It just seems like a lot of conflicting factors, but that's why I brought you on, to make some sense of it. Could you give kind of an overview of what you're seeing?
What I hear and see and speaking to different contacts within the business is that it's no great shakes. We're not at the numbers that we were certainly in the COVID era and so on and so forth. So I'm comparing from that perspective to today it's certainly off, but listen, they still The larger builders still, I mean, they're national companies, they're publicly traded companies. They still have to build homes, right? So the margins are tighter. The land they're working on certainly. Well, what happens? Certainly, the land costs. They're negotiating better deals. Are certainly the larger builders are certainly land banking them, but I still see that there is movement. Right? Is the bigger theme here today. They're still in business. They're building. Specifically within South Florida, I can tell you it's still South Florida. There's a limited amount of land to build. You'll see within southern Dade County, it was at one point a very agricultural community. A lot of that area, again, is people that can't afford to be in the metro area of Miami. You're not starting to see, certainly there's a big shift to the Homestead area that is still affordable per se, right? Affordable calling, 400,000 or 500,000 affordable.
Can you talk about what trends that we've seen in terms of builder confidence? Why aren't builders more confident right now? You would think that they have all these tailwinds at their back of, there's demand out there.
Yes, it's certainly the uncertainty economically of what's going on. The current administration has, certainly with the tariffs and using that as a stick, and it certainly the borrowing cost has increased. It's a lot more. There's a lot more risk in today's environment to go get 20, 30, 40, 50 million on credit out there to go build a community, or even higher than that. So I think they're just hesitant in trying to wait for, call it a flat spot, where you have some even footing under you to go ahead and really start to ramp it up. And again, going back into having that confidence.
Yeah, and you mentioned something in your first answer that I want to address, and that's land banking. And you're seeing that happen with Lennar and D.R. Horton, some of these big builders, which essentially allows them to manipulate their balance sheet. Can you
Correct.
explain the practice and then why it's becoming popular and what it's allowing builders to do?
As you indicated, right, builders can't have that sitting, just land on their balance sheet. So they'll go ahead and get a third party to land bank it. And when they're ready to go certainly get financing to go build the community, they'll go ahead and buy that back for a fee, or, a predetermined fee, so that they can go build that community.
Yes, I saw some commentary by you where you had mentioned that it's a buyer's market out there and you expect it to remain a buyer's market, but although interest rates are elevated. Why, can you kind of give some details on why, even with interest rates where they are, you feel like buyers have the advantage?
Yeah, I mean, I can certainly speak to South Florida, where it's been the highest inventory in a long time. You're starting to see, specifically, we're really within the condos. There's a really big market disruption within that, right now, and you're starting to see that come down. I saw an example, local publication, an article where someone started with call it $390,000-$400,000 property a year ago. It's down to 300, and there's still no buyers for it. So I certainly see that the buyers have advantage, and I personally, I still do a little bit of retail origination, and I see that that it's busier. Like, I'm getting more phone calls that, hey, listen, I just put this property under contract. I'm looking to buy this, or I just bought this cash. I need to go ahead and I want to put debt on it. So I see, that certainly has picked up, but it's not certainly, over the previous years.
Yeah, I almost get the sense that things are becoming so metro specific. You mentioned Florida. There are other states are seeing inflows. Some of the COVID era stuff is correcting itself. I'd like to ask you, though, when it comes to borrower sentiment, it was for the past couple of years, it was, oh, rates are way higher than what they were. I can't get, my friend is a 3% 30-year fixed rate. I can only get a 5 or 6 or whatever. It seems like the borrower sentiment has changed where now it's okay, I'm okay with a 6 or 6.5% rate. Maybe I can refinance in a couple of years. I'd like to own a home. And so that's normalized a little bit. When you think about the origination side of things, what are you seeing from borrowers or potential borrowers out there in terms of the way that they're viewing the market?
Call it the mid 22, the end of 22, where rates spiked up, and they're like, okay, I'm going to wait. I expect rates to come down. Well, it's 3 years later, right? So people are now getting used to a 6, 7 handle, and that's as you certainly heard the adage out there, marry the house, take the rate, and that's certainly what we profess as well, because what happens when this market does turn and rates go down? Well, now you're going to go ahead and values are going to go up, so you don't want to miss out on the opportunity of home ownership. So I gotta. It's more normalized where people are like, okay, well the rate's 5, 6, 7%. It is what it is. I want to go. I want to own a house. So we're seeing that.
Any data points or trends you're looking toward as we move through the second half of 2025 here? Kind of what are you keeping your eye on from a macro perspective?
What I'm seeing is more boots on the ground, or hearing of the continuation of your. It's people are like, okay, well, it's not busy. Well, I gotta disagree with that, right? Because it is busy for people that want to work, that want to pick up the phone, on the origination side, to go ahead and build those relationships. Whether it be from our business, from a wholesale side, to go build that relationships with those brokers, those mortgage brokers, mortgage banks, or the LOs to build, solidify, and work on building a business, with realtors and other referral partners. So I'm watching that. I'm listening to brokers. I go out with, and certainly visit offices with our own account executives on the wholesale side. So, we're looking to help promote their businesses as well, to see how we can build a partnership with these other brokers or bankers that are our partners in this, to see how we can help support building their business. Because look, Robbie, we're in the money business. People are going to need money, and I just see this as a truly potential now to solidify your relationships, to go ahead when the market really is on full tilt, to really step on the gas. And now it's not like you're playing catch up. Well, you are there supporting those realtors, those referral partners now when the times are tough, right? So I've seen that, in speaking to our counterparties, that people are out there building those relationships, and they're optimistic. The people that are working are optimistic for the second half of the year.
Is I want to stay on that subject quickly before I let you go here, and that's just winning business in general in the origination space. The relationships are huge. Referral business is huge. We've seen plays with some of the bigger players in the space, and I think they can kind of go nameless, but there are a couple companies out of Michigan
Mhm.
trying to acquire different parts of the process to get more lead generation. When it comes to what you're doing at Foundation Mortgage, what's kind of your focus in terms of how we're winning business and what's important to our customers?
Well, I think you really hit the nail on the head with, when you said relationships, because life is really all about relationships. Um, and that's, for every sector of your life. It's not what you know, it's who you know. And can you pick up that phone and get in touch with a C-level person to make a decision on whether it's, hey, can you do this loan? We need an exception. Or, hey, listen, I'm sitting at closing, and now the money came out of a different account we didn't have verified. Well, it all just comes back to relationships, and that really, is how I was able to build, my success, was the relationships that I formed over a 30-year period, to be able to pick up the phone and you got a deal that's going sideways, and get on the phone with a decision maker, as opposed to, well, I got to talk to, the AE, who's got to talk to the account manager, who's got to talk to underwriting, who's got to talk to the head of credit, who they need on an exception, once a month, right? Well, you lost that deal and you blew up that relationship. So I feel that it's important for everyone, whether it's on, the wholesale side or even the retail side, is develop those relationships, because that's what makes you successful within any business, but specifically to the mortgage business, it's to build those relationships.
Could not agree more. It's nice to see with technology the way it's progressing and creating some efficiencies in the workflow, that people are freed up to focus a little more on the relationship side of things. And for the largest purchase in any consumer's life, they need a good relationship, and it's encouraging the way that the industry is trending in that sense. So I want to thank you very much for the time. I'm glad you and I now have a relationship, if you will, and I appreciate you
Right
being
on.
a listener and a reader, and hopefully we'll have you back on soon.
Sounds good. Appreciate your time.
On the data front, we learned yesterday that the Federal Reserve's preferred measure of underlying inflation increased in June at one of the fastest paces this year, while consumer spending barely rose, underscoring the dueling forces dividing policymakers over the path of interest rates. The core personal consumption expenditures price index, which excludes food and energy items, rose 0.3% from May, according to U.S. government data. It advanced 2.8% on an annual basis, a pickup from June 2024 that underscores limited progress on taming inflation in the past year. Separately, consumers grew a bit more optimistic on coming conditions in July, but households remain hesitant. Tariff fears and a steady moderation in the labor market continue to leave them less confident in their job prospects, which could limit their capacity to keep spending. Initial jobless claims increased slightly from last week after 6 consecutive week-over-week decreases. And mortgage rates fell for a second straight week in Freddie Mac's primary mortgage market survey, with the 30-year mortgage rate declining 2 basis points to 6.72%. The July payrolls report led off today's calendar. Non-farm payrolls increased by 73,000, missing estimates and indicating cracks in the labor market. The unemployment rate in July was 4.2%, as expected, and up from 4.1% last month. Average hourly earnings were up 0.3%, as expected, month over month, and up 3.8% year over year, versus 3.7% in June. Later today brings the final July S&P Global Manufacturing PMI, the ISM equivalent, and final July Michigan sentiment. After the salvo of employment news, agency MBS prices are better than Thursday's close by 1/8 to 1/4, the 2 years yielding 3.83, and the 10 years yielding 4.32 after closing yesterday at 4.36%. Let's wrap up with a joke and some housekeeping. A guy walks into a bar and asks the bartender, "If I show you a wild trick, will you give me a free drink?" The bartender shrugs. "Sure, why not?" The guy reaches into his pocket and pulls out a tiny mouse. Then out of the other pocket, he pulls a teeny tiny piano. The mouse stretches, cracks its knuckles, and starts playing the blues like a rodent Ray Charles. Stunned, the bartender pours him a free drink. After finishing it, the guy says, "Now, if I show you an even better trick, do I drink free all night?" To which the bartender says, "Buddy, if you can top that, you're drinking on me till closing." So the man pulls the mouse and a piano out again, and this time reaches into his coat and pulls out a small bullfrog. The frog clears his throat and starts belting out soulful blues lyrics. The mouse is playing, the frog singing, the bar is dead silent in awe. Suddenly a man rushes up and says, "I'll give you $10,000 for that frog." "Nope, not for sale," the guy says. "25,000. "Nope. 50,000. Cash." "Deal." The bartender's jaw drops. "Are you crazy? That frog was a gold mine. Why'd you sell him?" The man smirks and says, "Relax, the frog can't sing. The mouse is a ventriloquist." Today's podcast is brought to you by Encino, makers of the Encino Mortgage Suite for the modern mortgage lender. Encino Mortgage Suite's 3 core products, Encino Mortgage, Encino Incentive Compensation, and Encino Mortgage Analytics, unite the people, systems, and stages of the mortgage process into a seamless end-to-end solution embedded with data-driven insights and intelligent automation. See how Encino can support a homeownership journey that your borrowers and your team will love at encino.com.